Good morning and welcome to this year's sustainability webinars. I cannot believe it. It feels just like yesterday when we had our last webinar for 2024. And now we're in 2025, we passed Australia Day and the year has really started. 2025 is a really important year for sustainability in Australia because from 1 January 2025, we've got mandatory sustainability reporting um, in the annual report for many Australian entities. So welcome to this webinar and welcome to the series of webinars that we've got scheduled for 2025. So my name is Aletta Boshoff and I'm the National Leader for Sustainability at BDO and also IFRS and Corporate Reporting. And I'm an advisory partner helping many clients get ready for sustainability, in particularly mandatory sustainability reporting. BDO would like to acknowledge the traditional custodians of country throughout Australia and their connections to land, sea, and community. And we pay our respects to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples here. In Melbourne, I'm on the land of the Wurundjeri people of the Kulin Nation, and we pay our respects. As I said, this is the very first sustainability webinar for 2025, the one in green. We look at the year of mandatory sustainability reporting and let's get ready. But we've also scheduled another 11 sustainability webinars for the rest of the year, one every month. And in February, we'll be looking at the strategic role of AASBS 1 and other voluntary frameworks. They continue to play an important role. And then from March, we focus on AASBS 2. And we will look at the governance pillar. We will specifically look at the strategic pillar. We'll look at the risk management pillar. We'll also look at metrics and targets around your carbon footprint setting targets. And finally, we'll bring it all together in November to prepare the first mandatory sustainability report. And then in December, making sure that we are assurance ready. So the very first entities in Australia that will have to do mandatory sustainability reporting will be those Group 1 entities with a 31 December year end. So that's our plan for the year, a big focus on AASBS 2, mandatory sustainability reporting, and we hope you can join us for the whole series. We also do monthly IFRS and corporate reporting webinars. That's wearing my other hat. But there's a lot of interaction between what we do in sustainability and what we do in IFRS and corporate reporting. For example, in March, we discussed accounting for power purchase agreements. So a lot of entities enter into power purchase agreements to make sure that they've got supply of green energy. So how do you account for those in your financial statements? In June, we talk about accounting for climate and other uncertainties in financial statements, which is sitting next to the sustainability report. We also look at, in October, we look at accounting for Australian carbon credit units. Again, many entities purchase these credits, or they generate these credits, or they buy and sell these credits. What are the accounting? So there's a linkage between the sustainability monthly webinars and the IFRS and corporate reporting monthly webinars. We already had our very first IFRS and corporate reporting webinar last Wednesday, and we looked at what's hot and what's not in 2025. And I was joined by Kevin Frobus and our new partner here in Melbourne, Dean Arden. Then, back due to popular demand, and it really is popular demand, and that is our carbon accounting masterclasses. We ran these masterclasses last year across the country in May and again in November, December. And we're going for the third series of carbon accounting masterclasses. The very first one I'll be running here in Melbourne on Tuesday, the 4th of March. I'll also be running the virtual session on the 20th of March. Ashley Woodley will be running the Perth session on Friday, the 21st of March. In Sydney, Kevin Frobus will be running the masterclass on Tuesday, the 25th of March. And in Brisbane, lucky last, on the 28th of March, Tom Hockman will be running that masterclass. So please register for these masterclasses. Critically important to get all the vocabulary, all the knowledge, set your team up for success, be assurance ready, and often it starts with getting all the knowledge. So please register for these. Now, I thought today, it's the start of 2025 for all practical purposes because holiday is now over and done with in Australia. Let's start with a countdown to our top tip for 2025. So I came up with 10 tips, and I'll start with tip number 10 and work through to our top tip to get you ready for mandatory sustainability reporting in Australia. So that's the plan. So let's start with tip number 10, and that is data and technology considerations. I know a lot of people have been talking about the need for data, complete data, technology to assist organizations around data, and I agree, it's incredibly important. We know there are data demands from your stakeholders. And so some of your customers, some of your suppliers, some of your investors, especially if your investors are super funds or PE funds or global investors, they might be asking for data from you. Often the data is around their requirements to measure their carbon footprint or their requirements to do sustainability reporting. And they come to you and they say, please provide the following data so we can do our calculations, our reporting. So it's important when stakeholders come to you that you are ready to respond. Now, years ago when we started on sustainability and when I spoke to clients, they would say to me, Aletta, but my stakeholders haven't asked for this data. What I'm finding now is that when I speak to clients, they say, yep, the bank has asked for this already. Yes, Superfund have asked for it. Aletta, here's an email we received. Here's a questionnaire we've received. A key customer came to speak to us. So this is happening. So who are your stakeholders? What are their commitments? What do they have to do? And therefore, what are their data demands? And what data demands will they put on you? Now, often this comes, if it's a customer, it comes through a procurement, for example. So we have to be ready to provide this information to them. So data, incredibly important. On the right-hand side, it's also important to think about your value chain. So which entities are in your value chain? What information would you need from them in order to do mandatory sustainability reporting, in order to measure your carbon footprint? Have you started to engage with your entities in your value chain, and are they ready to provide this information to you? So on the one hand, people can ask you for data and information, and we have to be ready. But on the other hand, you have to ask for information and what's the best way to do that in an efficient process. So it's correct. Data is incredibly important on this journey. And therefore, I would say top tip number 10 would be to consider data demands from your stakeholders and data demands on your value chain. I thought I'll go on to tip number 9. And that is the need for education and knowledge transfer. So many of our clients, when we start working with them on sustainability projects, would say, we don't have the knowledge in-house and we want to work with BDO to deliver the project. But it's also important for us that there's a knowledge transfer during the project. We want to upskill our own team. Sometimes it's even upskill the board, upskill executives, upskill our finance team, upskill the broader organization around sustainability, what it means, why they should care about it. To embrace a new area like sustainability without the necessary information and knowledge is really hard. Um, the other thing that we're finding is finance teams, when they prepare financial statements, most of them have studied finance, commerce, accounting at university. There's a base level of knowledge, so they can prepare financial statements. However, when those same finance teams now get involved in carbon accounting, get involved in sustainability reporting or broader sustainability, that base level of knowledge doesn't exist because it's all new. And therefore, that knowledge transfer education would be my tip number 9. And obviously, to assist you on that, that's why we've got the monthly sustainability webinars. And by the way, if you've missed the previous 3, 4, 5 years of webinars, it's all on our website with the PowerPoints, etc. But that's why we're doing this, to take everybody on a journey. At BDO, we are really passionate about education. We are passionate about knowledge transfer. And therefore, this is available on our website for free, not only for our clients, but anybody interested. And another part of the education is the Carbon Accounting Masterclass, which I talked about. The Carbon Accounting Masterclass, maybe I should expand. It's a whole day, and we share with participants our BDO Global Carbon Accounting methodology. We share case studies. We've got 27 case studies and their solutions. And it's really making sure that we're all on the same page on what is a carbon footprint, what are all the categories, how do we measure it, what are the alternative methods available, how do you become assurance ready, how do you capture, document the data. So really a big knowledge transfer exercise. Tip number 8, please be aware of the risk of greenwashing. So when we look at greenwashing, maybe a little bit of statistics first of all. The ACCC did a bit of a review of websites, and they reviewed 247 websites. And they came up with their findings in this report, and there's a link to the report. And they found that 57% of these websites made concerning claims about environmental credentials. So at the time when this was done, it was a focus on environmental aspects. Now, if we look at sustainability, it's broader than just environmental credentials. So really important that organizations take a hard look at what is on their website around sustainability. And if they get questions on information published on their websites, that they can support it with information. So, if you want to publish a carbon footprint on your website, are you happy that somebody come in and they can look at that calculation, it's assurance ready, and that it can be substantiated? If you want to publish targets, do you have plans behind it that you could realistically achieve those targets? I think there's a big focus on measuring carbon footprint, and a lot of footprints have been calculated over the years that maybe there's now some doubt. Did we do it right? Is it complete? Was there assurance over it? So please have a look at your websites. What are on your websites around sustainability? What are on your websites around your carbon footprint, around your targets? And can you support that? Because we do not want to be subject to any greenwashing. Obviously, I think there's now, when all of this goes into the annual report, and it will require assurance, there's a big focus on having a look at all this information. But there should be no difference between the credibility of information on your website and the credibility of information in that mandatory sustainability report. Same systems, processes to make sure that there's no greenwashing. So just a reminder to just be aware of that risk. Tip number 7, and I've just touched on it in the previous tip, but I want to come back to this one, and that is understand what assurance ready really means. We always talk about if you put information together to put on your website, if you put information together to go onto your mandatory sustainability report, if you put information together to go into a voluntary sustainability report, make sure that that information is assurance ready. And this is becoming more and more important because in that very first year that we've got a mandatory sustainability report, certain aspects will be subject to assurance. And from the second year, absolutely everything will be subject to assurance. So today, if you are working to put all of this together, how do you make sure that it is assurance ready? And what does assurance ready really mean? So that's really important. Um, the Auditing and Assurance, the Australian Auditing and Assurance Standards Board have in December at a meeting decided to change their approach to phasing in assurance over the mandatory sustainability report in Australia. And this is the latest thinking. I've got a link there to the highlights of the meeting in December where they've published this timetable. There's a few things I want to point out here. Number one is they've talked about years 1 to 6, but then they further articulated in year 2, in row 2, 3, and 4, what does year 1 look like for group 1 entities? And when is year 1 for group 2 entities, and when is year 1 for group 3 entities? So previously there's been a bit of confusion, about, is it the same starting point for all 3 groups from an assurance perspective, or is it taking into account the phasing for the particular group? So here you can see it is when is year 1 for your particular group. So if you're in group 1, year 1 for you will be years beginning on or after 1 January 2025. However, year 1 for group 2 entities will be years beginning on or after 1 July 2026. And for group 3, year 1 would be years beginning on or after 1 July 2027. So there's a phasing from assurance perspective, which takes into account the phasing of IFRS S2 or AASB S2 in Australia. Now, what's important, once you know what is year 1 for your particular group or entity, you then consider what kind of assurance will be required. Now, in that first year, they've decided that it will only be limited assurance and only over 3 areas. So limited assurance over governance aspects, limited assurance over strategy or the strategy pillar. But you can see there's 4 stars next to it. And if you go right to the bottom, it says you only need limited assurance over subparagraphs 9A, 10A, and 10B of AASB S2. Now, there are a lot of other disclosure requirements around strategy, but in the very first year, only those subparagraphs will be subject to limited assurance. You also need limited assurance over your scope 1 and 2 emissions. What's important to note is all the other aspects required by AASB S2 has to be disclosed. However, only certain things will need limited assurance in that first year. In the second year that entity is doing mandatory sustainability reporting, it will be limited assurance over absolutely everything required by AASB S2. And remember, in that second year, scope 3 emissions comes in. So in the first year, we don't have to disclose scope 3 emissions. Year 2, we have to disclose it, and immediately we need limited assurance. And then from year 4 onwards, we need reasonable assurance. Now, I'm not an audit partner, but what's the difference between limited assurance, reasonable assurance? At a very high level, limited assurance more analytical type procedures, more at a high level review type procedures, where reasonable assurance is normal audit, extensive substantive procedures. So we start with limited assurance and then reasonable assurance. So I think this is a very handy timetable to give you an idea when assurance will be applicable to your organization. And this is different to what we've discussed in webinars last year, because this is a decision that was made in December 2024. I thought it might be a good time to just consider, what does assurance really mean, or assurance ready, for example, over your carbon footprint. Now, when you look at your carbon footprint, we know there are 7 sources of greenhouse gases, or 7 types of gases that are captured within the greenhouse protocol. So it's really important that you make sure that when you measure your carbon footprint, that it's complete, that you consider all 7 potential greenhouse gases, and that you don't include other gases. So it's only these 7 gases from a completeness perspective that have to be picked up, nothing more, nothing less. So, focus on those. When BDO look at our BDO Global Carbon Accounting Methodology, and this is what we discuss in the Carbon Accounting Masterclasses, we came up with 10 steps. From an assurance readiness perspective, the one aspect that is really problematic is what I've got there at the bottom: prepare a basis of preparation, the big grey block, which really spans from step 1 to step 7. When the auditors arrive, the very first thing they ask is, can we see your basis of preparation, or your carbon accounting policy, or your carbon accounting methodology? If you don't have that, and if it's not documented adequately, how can they look at anything else? How can the auditor go any further? So the first step is, what is your basis of preparation? They review that to make sure it's aligned with the greenhouse gas protocol. And then they move on to see whether the actual calculation that you've performed is in accordance with your basis of preparation, which they've established is aligned with the greenhouse gas protocol. So if you have no basis of preparation, it's a huge red flag, and actually an inability for auditors to move forward. So be assurance ready. Make sure you've documented your basis of preparation. So that is considering steps 1 to step 7. So it includes your organizational boundary, your operational boundary, identify the sources of emissions, determine which emissions should be included, what are the different calculation approaches, which ones is best for your organization, identifying appropriate emissions factor, how have you done it? All of that have to be documented in the basis of preparation. And then only can the auditor move on to step 8, look at the calculation tool, look at how it's rolled up, how it's being reported. Incredibly important. Also, when we look at assurance over a client's carbon footprint, some high-level things to think about. Has the client identified all the greenhouse gases, which I flagged earlier? How has the entity ensured compliance with the greenhouse gas protocol? Did the entity consider whether the measurement of scope 1 and scope 2 under the ENGES scheme is aligned to the measurement of scope 1 and 2 under the greenhouse gas protocol? So the National Greenhouse and Energy Reporting Scheme has been in Australia since 2007. A lot of clients are telling me, we've measured scope 1 and 2 under the ENGES scheme, we've been lodging it for many, many years, and therefore only help us with scope 3. The problem is, there's an exercise to be done to top up, or potentially top up, scope 1 and 2 under the ENGES scheme to get to scope 1 and 2 under the greenhouse gas protocol. The reason is various reasons, but some of the high-level reasons. For the ENGES scheme, you look at a facility by facility basis. Some facilities might be excluded because they're below the thresholds. Some gases might be excluded for ENGA because they're below the threshold. And those thresholds don't exist under the greenhouse gas protocol. Also, under the ENGES scheme, entities could designate reporting to another entity in the group. Under the greenhouse gas protocol, if you've got control as defined under your consolidation approach, you cannot designate it away. So we have to look at that as well. So that's an important one. How did you true that up? Did the client prepare a basis of preparation? Is that basis of preparation in compliance with the greenhouse gas protocol? The fifth one is incredibly important. How did the client ensure completeness of data? Coming back to top tip number 10, completeness of data, quality of data. Did the client reconcile their carbon data back to their general ledger? You know, the auditors audit the general ledger to support the preparation of financial statements. If they can then use that audited general ledger to also support the carbon data, that will make for a very efficient audit. What technology did the client use? Does the technology provide a clear audit trail? And very importantly, you know, ASIC is often said from a financial reporting perspective, if it's not documented, it's not done. That absolutely applies to carbon accounting, everything to do with sustainability reporting. Not documented, not done. So incredibly important to look at these things as a start to get assurance ready over your carbon footprint. What about assurance ready over your other climate-related disclosures that's required by AASBS 2? Now, remember just an overview of AASBS 2, our reminder, we've got the 4 pillars around governance, strategy, risk management, metrics, and targets, and these are the key headings within AASBS 2. If you have to disclose, for example, your climate-related risks and opportunities, and you have to disclose your physical risks and transition risks. For an auditor to have a look at that and to have limited assurance over it or provide limited assurance over it, the auditors would like to see the process you've gone through to identify your physical risk and transition risks. That cannot miraculously appear in a risk register. You know, what process did you apply? And the documentation to support it, the thinking, the workshops, agendas of meetings, minutes of meetings, input from across the whole business. So what documentation do you have in place that you can say to the auditors, we've gone through a process to identify climate-related risks and opportunities? What methodology did you use to identify climate-related risks and opportunities? Now, that applies to everything. It applies to climate-related scenario analysis. It applies to the financial modeling that's required. How did you set your targets? What was the process for setting targets? Who approved the targets? So it's important to stand back and say, not only do we need these disclosures in AASBS 2, but when the auditors arrive, what do we put in front of them to show them that we've gone through a process to identify these disclosures and that they can provide limited assurance over those. Important that our Treasury Law Amendment Act that made changes to the Corporations Act also talked about the 2 minimum scenarios that they would like us to address when we do scenario analysis. Now, this requirement doesn't sit in AASBS 2. AASBS 2 just says do scenario analysis. But then in our Australian legislation, it's about the 2 different scenarios that's required. So the first scenario is a high global warming scenario, which is an increase of 2.5 degrees or higher would be considered to well exceed the current increase. And then also a second scenario, which is a low global warming scenario. So the increase of about 1.5 degrees above pre-industrial levels. So you have to make sure that you address at least these. So from an assurance ready perspective, have you considered these? How have you documented these? The last one is assurance over other sustainability related disclosures. So this would be a situation where you decide to do voluntary reporting. You might decide to use AASBS 1, which is voluntary. You might use World Economic Forum, IBC. You might use United Nations. You might use GRI. And you decide that in order to avoid the risk of greenwashing, which we've talked about, you want assurance over these voluntary sustainability reports. So what do you have to put on the table? How do you get assurance? I think it's incredibly important that you don't cherry pick these voluntary disclosures. And therefore, assurance providers would start with, who are your stakeholders? How did you engage with these stakeholders? How have you identified what your stakeholders are interested in? What are the material topics? So you cannot decide on behalf of stakeholders what you're going to report on, because that could be greenwashing because you're cherry picking the things where your KPIs are looking really great. So as an example, when you do a materiality assessment, this was a materiality assessment we did for BDO Australia in 2022, and we're in a process of redoing it now in 2025. And we went with 24 topics, got feedback from partners, staff, clients, key stakeholders, and in that green block, that is the items that were important to our stakeholders, important to our company, and that's what our voluntary sustainability report is focusing on. So we start our voluntary report with this and said, this is what our stakeholders said, this is what they care about. So I would imagine if an assurance provider arrives and they want to look at a sustainability report, voluntary sustainability report under any framework, first question would be, how have you decided what to put in your voluntary sustainability report? How do I as assurance provider know that you haven't done cherry picking, that you're actually addressing the needs and requirements of your stakeholders? So again, just a few pointers on assurance ready. Going back to our countdown, I must say the countdown reminds me a bit of when I was a teenager and we would listen to the top 100 countdown or the top 20 every week. And we're sitting there with the old tape recorder and we wanted the announcer to stop talking so you can press record. So that's good old days. I think many of the attendees might not remember the good old days of a recording on little tape recorders, but there was this countdown of the top 20 or top 100. So on sustainability countdown, number 6, very important to understand your mandatory obligations. Now, I want to do a slightly different thing here. I think most people would expect me to focus on mandatory sustainability reporting because that's the key thing that's new in Australia from 1 January 2025. I want to take a step back though and say if we look at broad sustainability, there are some mandatory requirements that's been in for a while. So for example, we've got the Modern Slavery Act that's been in place since 2018, which says that an Australian entity or entities carrying on a business in Australia with a minimum annual consolidated revenue of 100 million need a modern slavery statement, and they need it on their website and they have to lodge it with the regulator. That's a mandatory sustainability related item. Another one, which I believe is a sustainability related item, is the payment times reporting scheme. And I've included there a link to an article that we've written in 2021. So it came into play from 1 January 2021. And it's talking about organizations that have total annual income of more than 100 million, or if the entity is a controlling corporation, combined total income of the controlling corporations group exceeding 100 million, etc. Then you have to do payment times reporting, which again has to be lodged with a regulator. And payment times reporting is trying to ensure that big business pays their suppliers and smaller suppliers in a timely fashion. And if they're not, at least it's quite visible that they're paying them very slowly. So payment times reporting scheme, again, a sustainability type measure and mandatory for certain organizations. Another one to look at that's been in place for a while is Workplace Gender Equality Agency Australia reporting. And again, here it's starting with big businesses, and it says, employers who have not reported previously must register with the agency if they have employed in total 100 or more employees for 6 months or more of a reporting period. So that's an extract from the website, and there's a link to the website. So we have a number of mandatory reporting already in place across the broad area of sustainability. Usually, with all of these, it is you have to mandatory report to a regulator. And usually that regulator would make it publicly available so anybody can have a look at it. What's different now is we now have legislation that mandates sustainability reporting within the annual report. So it's not just going to ASIC or another regulator, it's sitting in the annual report. It's got assurance over it. So very important, it's not just straight going to a regulator, it's in that annual report, it's going to investors, going to the market, widely available. And the things we've got in place is the legislation received royal assent on the 17th of September last year. We know we've got a reporting standard, AASBS 2, so initially only looking at climate-related disclosures, and then we have an assurance standard, IAASB, and we're waiting for the Australian Auditing Assurance Standards Board to issue the Australian version of that, but I'm not expected to have significant changes. And as I've said previously, there was an exposure draft on the right-hand side at the bottom on how they're going to phase it in. Earlier in this webinar, I've given you an update on that. So we've got legislation, we've got a reporting standard, and we've got assurance requirements. It's very important that organizations assess when this will apply to them, if ever. So if we talk about mandatory reporting, are you group 1, 2, or 3? And the criteria is you could be caught because of size, because you're an ENGO reporter already, or you're an asset owner. And this is a little bit of a high-level table talking it through. Just a reminder, if you look at criteria 1, if you meet 2 of the 3 criteria within the size thresholds, you would meet that hurdle. But if you look at criteria 1, 2, and 3, if you meet any of them, you would be captured. I think, however, a very important thing that's often overlooked is flagged in this diagram, and it's the first 2 questions on this diagram. The first question is the entity lodging a financial report with ASIC as required by Part 2M of the Corporations Act? So I would ask a client, are you lodging a financial report with ASIC? And if they say yes, second question, why are you lodging a financial report with ASIC? Because if you are lodging a financial report with ASIC because you are required by Part 2M, large, private, etc., then you're definitely within this regime. If you are lodging with ASIC required by another part of the Corps Act, then you're still out of the regime. So it's only Part 2M, so public companies, large private companies, etc., which will be caught. So that's a key question. If you're not lodging under Part 2M, you're out. But then if you're lodging under Part 2M, the final legislation came with a bit of a surprise, and it said in the dark grey block on the left, is the entity a subsidiary whose ultimate Australian parent entity prepares and lodges a consolidated sustainability report with ASIC? So if you're a subsidiary and your ultimate Australian parent is already doing a consolidated sustainability report, you don't have to do your own sustainability report for your subsidiary, even though you are lodging with ASIC. So sometimes in a group, the parent is lodging consolidated reports, and there could be various subsidiaries that are also lodging financial reports with ASIC. In that situation, you don't automatically also have to do that sustainability report for each subsidiary. Somewhat of a technical analysis, but important to get that right. You want to make sure you know which entities in your group are lodging with ASIC a financial report, and which of them also have to lodge a sustainability report. And if the subsidiaries can get out, if the parent is doing it for the whole group, is that to your benefit? Remember, we don't take any consideration of an ultimate parent sitting in Europe doing a consolidated sustainability report. It's the ultimate Australian parent. And then you go further and you're looking, are you a registered scheme, registrable superannuation entity, etc. But please note, you have to first consider, am I lodging with ASIC under Part 2M? And if I'm lodging with ASIC under Part 2M, am I a subsidiary of an ultimate Australian parent that does consolidated reporting? Because if you get scoped out there, you don't have to worry about the rest of this decision tree. So just look at this carefully. Your climate reporting timelines, important to look at, if you're 31 December year end, 31 December this year, Group 1 entities. If you're a 30 June year end, we're talking about 30 June 2026. So it's a bit of a summary. And remember, your annual report will now consist of your annual financial report, annual sustainability report, not required in interim reports. Don't have to do a sustainability report in a half-year report. Then you need a director's report and an audit report. The other thing, as part of the mandatory reporting that to be aware of, is your annual report will consist of your financial report, sustainability report, and that sustainability report is a defined term in the Corporations Act. So you cannot call anything else that you put on your website a sustainability report, because a sustainability report defined in the Corps Act have to be in your annual report subject to assurance. If you want to do other voluntary disclosures around sustainability, you need to name it something different. So supplementary voluntary sustainability report. And then this is just again an overview of the requirements of AASBS 2, which is talking about what are the things that should be included in that mandatory sustainability report in the first year with a focus on climate. My tip number 5, we're getting to the top 5. Assign responsibility for sustainability. If you want to action this, you need to assign responsibility. Now, there's been a lot of debate over the years on who should be assigned sustainability. In my experience, organizations that do this really well have representation from different areas in the business, but ultimately responsibility they've assigned to the CFO or the head of finance. The reason is mandatory sustainability reporting. That mandatory sustainability report becomes part of the annual report. That annual report is subject to assurance. The CFO usually oversees the whole process to prepare financial statements that's been subject to audit for many years. Therefore, the CFO is familiar with what's required to be assurance ready, the systems, the processes, liaising with the auditors, liaising with the Audit and Risk Committee, with the board around the annual report. The CFO by no means does this alone. They need input from sustainability people, from legal team, from their HR teams, etc. But important to assign responsibility to someone. So ultimately responsibility is with the board. Usually the board would assign it to the Audit and Risk Committee, and usually at an executive level we see it with the CFO. This is what we've seen over the last 2 years. So CFOs, when we did our survey last year, or BDO US did the survey last year, They talked about they see ESG risks evolving, so it's not disappearing. And CFO realized that they have to look at the risks around sustainability. There's a strategic risk around sustainability, and there's also a mandatory reporting risk around sustainability. Some of the tips that came out of that survey was don't wait to prepare for those sustainability disclosures or the mandates. Get ready. Look at your risk identification around sustainability and create those enforcement processes. And then as a result of that research, we came up with a finding that we really see the CFO as an ESG champion. And so in previous years, 5, 10 years ago, that was not the case. But I think the fact that we now have the mandatory sustainability report in the annual report is asking for a CFO to step up and be the ESG champion or project sponsor, and to coordinate all the efforts and get it sustainability assurance ready. Tip number 4, get the board on board. Incredibly important that the board is across all of this. The board sets the tone at the top. So the board would have to know what's coming down the mandatory route. They have to know what are the strategic drivers, the value drivers. Incredibly important to get the board on board. If the board is not on board, the CFO, the executive, the sustainability team will have a really tough ask. So some of the things the board would look at is, obviously define oversight responsibility, which board committee will look after it. For example, Audit and Risk Committee. Is the CFO responsible, or who's responsible? How are we going to identify, monitor, and oversee the risks? What controls will we have in place around decision-making, reporting? What is the accountability at an executive level, etc. So very important to get a board on board, and that's tip number 4. Also wanted to flag that BDO provides complimentary board updates, presentations, or workshops, depending on what the need of the client is. Sometimes it's a letter, we've got 15 minutes, please do a board update. Sometimes we can get half an hour, sometimes it's an hour, sometimes the board would like 2 hours. And we do these on a complementary basis to get the boards on board, acknowledging how important that is. Tip number 3, why are you addressing sustainability? I think the why is so important. Unless you've got this why clearly locked into your organization, it's going to be a struggle. The why around sustainability in general, including sustainability reporting, is that it's now a ticket to play, or a part of your license to operate. In order to get access to debt capital from the banks or other debt providers, equity capital, super funds driving this really hard, private equity driving it really hard, or access to markets, customers, we know they're driving it really hard, and access to people to work in your business. Be very clear on why you're doing it. What's the value in doing it? Personally, I hate to speak to boards or clients and say you have to do it because there's mandatory reporting. I believe organizations should do it because it is a ticket to play. It's a license to operate. There's value to do this. And unless we get this right, it's really hard to just focus on the mandatory side. So I think the why is the carrot, the mandatory reporting and the assurance is the stick, and we need a bit of both. So make sure you understand where you sit in this ecosystem, who are your suppliers, your customers, your investors, your employees. Tip number 2, I would say it should come as no surprise, is to develop a roadmap and a detailed project plan. So our clients start with, we want a roadmap. We want to see how do we get ready. So the client have established they have to do mandatory reporting in 2027. And now they want a roadmap. How do we get ready? At a high level, how do we get ready? What do we have to do? When do we have to do it? Which financial year? That's a good start. but then it has to go over in a detailed project plan to make it happen. So, we have developed a number of roadmaps. So entities with 31 December year ends, and they are the first cap of the rank. We've put it over a number of years. 31 December 2025, we've got mandatory reporting over a number of aspects, scope 1 and 2, and the rest of IFRS S2. We have previously said for 31 December financial year in that red blocks, that's the things you should have done. Started with all those things. So I would say if you have a 31 December year end, you are group 1 and you have to do 31 December 2025, and you haven't started with the things in this red block, we've got a problem. And we need to have a conversation very quickly, because there's a lot of things that should have happened that will have to happen now before 31 December 25. But then we also, if it's 31 December, if you're group 2, we're talking about 31 December 2027. What can you do slowly to get ready? And also, if it's a group 3 entity, what can we do slowly to get ready? But we've also looked at 30 June year end. So if you are a group 1 entity with a 30 June year end, what are the things that you should do now? Now, absolutely, carbon, we've talked about so many times. There's a lot of things to do around carbon. But the red block I've put here around a few things that are often missed around conduct a climate risk assessment, do scenario analysis, do financial modeling, prepare a dry run draft report so that the board can get across what will go to market in a year's time. So we've got some roadmaps for 30 June year ends as well. The detailed project plan, we usually work with clients to say, okay, if we look at the 3 different project streams that we have, for example, the different teams, what your deadline is, what are the detailed deliverables, and how do we monitor this? And usually when we do this work for clients, we report to the CFO and the board on a very regular basis on how we're tracking against this detailed project plan. We're now at a stage that a roadmap is not good enough. We really need that detailed project plan to get ready in time. Absolutely number 1 tip, no doubt, absolutely no doubt, is that all roads lead to carbon accounting. So you have to start by measuring your carbon footprint. So whether you look at sustainability strategically, value creation, commercially, or whether you look at it from a mandatory sustainability reporting, you have to start to measure your carbon footprint yesterday. This is critical. Everybody's asking for it. Each and every stakeholder of each and every client is saying, I would like to know what this entity's carbon footprint is, what their targets are, how they're tracking. Absolutely, we have to look at starting and measuring your carbon footprint. We look at the Greenhouse Gas Protocol, huge body of literature to measure that carbon footprint. Then there is, we've got a bit of an overview where to start. What's scope 1, scope 2, scope 3, and this is what we discuss in those master classes. There are 20 categories across the 3 scopes. Do you understand the various methodologies available, data required? How can you set a target if you're not fully across this and assurance ready? Which brings me back to the carbon accounting masterclass. So that's my top 20 on what to focus on in 2025. I would like to end the session by just looking at some private equity predictions. Now, we know private equity is really looking at sustainability, and I've included 2 articles in the presentation that you can look at. This one appeared in Accounting Times, where they talk about that ESG risk factors and policies are now a much greater focus in private equity deals, and the fund manager are incorporating ESG into valuation methodology, due diligence, warranties, indemnities, negotiations. And it's largely driven by investor mandates across the world. So I know there's a lot of talk about what is happening in the US and Trump making changes. But we know in Europe, We're knowing in the Asia Pacific region, there's a big focus on introducing mandatory sustainability reporting, introducing a commitment to renewable energy, to net zero, and that's not going away. So if we look at our global environment, a focus investor mandate around ESG, and also if we don't, even from a value perspective or a strategic perspective, if you don't comply with these ESG requirements, it can adversely impact talent retention, brand reputation, and marketplace acceptance. So that's an article that you could look at. Another one, there are three private equity predictions that was published in 2024. And one of them, the second one, said ESG risk will heavily impact the likelihood of successful deal completion. And I've highlighted there that recent surveys have highlighted that more than 80% of fund managers and general partners did not progress with an investment opportunity due to ESG related concerns. That's a staggering statistic. So private equity predictions, very important. We keep looking at sustainability measures. Finally, I know a lot of entities are currently busy finalizing 31 December 2024 financial reports, and others will be starting to think about 30 June financial reporting. I just want to reiterate that although we don't have mandatory sustainability reporting for 31 December 2024 or 30 June 2025, ASIC still has a focus on sustainability reporting. There's still a focus on the voluntary TCFD recommendations. They've flagged that nearly 75% of the ASX 200 have already committed to the voluntary reporting under TCFD. Remember that the TCFD is a stepping stone to getting ready for AASBS 2, and that there's an expectation that organizations consider climate-related risk the same way they consider all risks, and include that in disclosures. So this is a reminder of what the TCFD recommendations look like, and obviously we've built on this to get to AASBS 2. There's a TCFD checklist and some training. Finally, last aspect, how can BDO help? Now at BDO, we've set up our sustainability business across 4 key areas, 3 of them within advisory, and then obviously the sustainability assurance on the right-hand side. So if you look at the advisory parts of our business, we can assist with carbon footprint measurement and everything that goes with it around target setting, etc. We can help with sustainability reporting, whether it's the mandatory reporting or the voluntary reporting. And we can help with sustainability strategy, decarbonization, transformation of your business. So that's the advisory services. And then we also have assurance services. If you want to reach out, our sustainability advisory partners, you can see we've organized it across the 4 offices, Brisbane, Melbourne, Perth, and Sydney. Carbon accounting, sustainability reporting, sustainability strategy. And then if you look at sustainability assurance, these are the key contacts across our offices. Just to make it a bit easier to find a local representative to discuss this with. You can register for our IFRS and corporate reporting information in Corporate Reporting Insights. You could also subscribe for our Sustainability Insights, and we also have some e-learning available. So I would like to say thank you very much for joining this first sustainability webinar for 2025. I hope you join us every month as we unpack mandatory sustainability reporting over the next 12 months and helping you to get ready. I hope you have a lovely day. Goodbye.